Hey everyone, welcome back to Corporate Decoder, the place where we unravel the not-so-secret secrets of the corporate world, one filing at a time. Get ready because today we're diving into a report that shows some pretty interesting shifts for Cantor Fitzgerald Income Trust Incorporated. Before we dive in, if you like getting these unfiltered insights into company dealings, make sure you are subscribed, and for those who want to connect with fellow financial detectives, our Discord community link is in the description below. You should totally join. Alright, today we're looking at an 8K filing from Cantor Fitzgerald Income Trust Incorporated. Now, an 8K is like a company's immediate update to the public when something significant happens. Think of it as a company's diary entry for major events, and for this one, well, let's just say they've been busy tweaking the terms of how they operate, especially when it comes to managing money and how much they pay their advisors. It looks like the 1st of January was a big day for them making some crucial changes. The main story here is about changes to their advisory agreement. This is essentially the contract that outlines how an advisor, in this case Cantor Fitzgerald Income Advisors Incorporated, helps manage the company's assets and what they get paid for it. So they've entered into what is called a third amended and restated advisory agreement. What does that mean in plain English? It means they've sat down, tweaked the existing agreement, and made it official. And the big news within this agreement is that they are reducing the asset management fees. This is huge for the company's bottom line. Originally, the fees were a percentage of the company's net asset value, or NAV, which is basically the total value of its assets minus its liabilities. Now, the monthly fee is going to be an amount equal to 1/12 of 0.75% of the net asset value of the company per annum. So they're paying their advisors a bit less, which is definitely a win for the shareholders. This reduction means more of the company's money stays within the company rather than going to management fees. Another significant change is the elimination of a clause that previously limited the reimbursement of certain expenses. Before, if reimbursing these expenses would have dropped the company's net asset value per S-hair below $25, they couldn't do it. Now, that restriction seems to be gone. This could mean more operational flexibility for the company and its advisors, but it is also something to watch. It means expenses can be reimbursed more freely, which could impact profitability if not managed carefully. Following on from that, they've also made changes to their partnership agreement. Specifically, they've entered into a second amended and restated limited partnership agreement for their operating partnership. This agreement deals with how profits and gains are shared within the partnership, and the key change here is a reduction in how much a specific affiliate of the advisor gets as a performance participation allocation. It is dropping from a substantial 12.5% down to 5.0%. This is another clear indication that the company is looking to streamline costs and perhaps retain more profits. This significant cut in performance fees for an affiliate likely reflects a negotiation for better terms and a focus on profitability for the trust itself. It is a strong move towards aligning incentives and ensuring the company's financial health. Now, let's talk about how the company is handling its own stock. They've adopted what is called the 4th amended and restated share repurchase program. Think of this as the company's plan for buying back its own shares from the market. The big update here is how they prioritize repurchases. Now, if a stockholder's account holds less than $2,500 of the company's common stock, their entire repurchase request will be fulfilled first, provided there are funds available, after those smaller accounts are taken care of. Any remaining repurchase requests will be handled on a pro rata basis, meaning everyone else gets a percentage of what they asked for. This is a nice touch, essentially prioritizing the smaller investors and making sure they can exit their positions if they wish. It's a way to show support for the average investor. And finally, as part of this filing, they've included the actual documents related to these changes. So we have the updated share repurchase program and the new advisory and partnership agreements. These are the official records of all the tweaks we've been discussing. This exhibit, number 4.1, is the actual document for the share repurchase program. It lays out the specifics of how they will buy back their own stock, with that new prioritization for smaller account holders. Then we have Exhibit 10.1, which is the detailed third amended and restated advisory agreement. This contract is where you'd find all the nitty-gritty details about the advisor's responsibilities, and crucially, those reduced fees. And lastly, Exhibit 10.2 is the second amended and restated limited partnership agreement. This is the legal document that solidifies the changes to profit sharing within their operating partnership, including that significant reduction in the performance allocation. So, what does all this mean for Cantor Fitzgerald Income Trust Incorporated? Based on this 8K filing, the company is clearly focused on optimizing its cost structure and improving profitability. The reduction in advisory fees and performance allocations for affiliates directly translates to more money being retained by the trust, which is a positive signal for shareholders. The changes to the share repurchase program also show a commitment to supporting smaller investors, which could foster loyalty and confidence. Looking at the broader picture, these moves suggest a strategic shift towards greater efficiency. By negotiating better terms with their advisors and streamlining partnership agreements, they are positioning themselves to be more financially robust. The elimination of expense reimbursement limitations could offer more operational flexibility, but it's also a point to monitor to ensure it doesn't lead to uncontrolled spending. A notable risk is how these changes might affect relationships with their advisors and affiliates. While cost reduction is good for the trust, ensuring continued strong advisory performance is paramount. The opportunity lies in the potential for increased earnings and a stronger balance sheet as a result of these cost savings. The company seems to be walking a fine line, cutting costs effectively without compromising the quality of management or strategic flexibility. In conclusion, this 8K filing paints a picture of a company actively managing its financial structure for better returns. The core changes are about cost efficiency, making the trust more attractive to investors by increasing retained earnings and offering a more supportive repurchase program for smaller shareholders. It's a smart, albeit potentially complex, set of adjustments designed to bolster the company's financial health. Alright, that is our deep dive into Cantor Fitzgerald Income Trust Incorporated's latest 8. What are your thoughts on these cost-cutting measures and the changes to their share repurchase program? Let us know in the comments below. If you found this breakdown helpful, please hit that like button to support the channel. And be sure to subscribe for more corporate document dissections. And don't forget to join our Discord community. The link is in the description for more engaging discussions. Thanks for watching, and we'll see you in the next one.